Hi all, the topic for our presentation is capital risk in ING Bank, prepared by Nishad and Payal Mohapatra. Capital risk. The risk an investor faces that he or she may lose all or part of principal amount invested. The risk a company faces that it may lose value on its capital. The capital of a company can include equipment, factories and liquid securities. What is capital adequacy ratio? It is a ratio of a bank's capital to its risk. It is also known as capital risk weighted assets. National regulators track a bank CAR to ensure that it can observe a reasonable amount of loss. The formula for CAR, that is capital adequacy ratio, is Tier 1 capital plus Tier 2 capital divided by risk weighted assets. There is a chart for capital adequacy ratio which is showing in 2012 the CAR increased from 12.94% in 2011 to 14% in 2012. That indicates effective management of capital. Even though CAR was 14.91% in March 2010, hence it is coming back to that same level of position. The ways to increase CAR. Banks can increase the capital adequacy ratio in two ways: increasing the capital, decreasing the risk-weighted assets. It can also increase the capital by changing the portfolio of investments and loans and advances. Banks increase capital through IPO, that is initial public offers, FPO, follow-on public offers, rights issue, preference shares, stock split. Now the next slide will be continued by Nishad.
Hello, now we look at the quantitative disclosure on capital measurement and ratio. The Tier 1 bank ratio. Year-end actual Tier 1 ratio was 11.69% in 2011 compared to 12.25% in 2010. Regulatory minimum Tier 1 cap ratio was 4% both in 2011 and 2010. Target minimum Tier 1 ratio is also 10% in both 2011 and 2010. The Tier 1 ratio and the BIS ratio are the regulatory requirements internally ING manages on the core Tier 1 ratio, for which the target was raised from 8% to 8.5% in 2011. The actual ratios were 9.62 at the end of 2010 and also 9.62 at the end of 2011. ING expects the BIS ratio to lose its meaning. Now we'll look the capital position of ING Bank. Shareholders' equity of parent company was 34,367 in 2011. It was slightly declined from 2010, even though it's a good figure. Comparing to 2010, minority interest has been increased. The subordinate loan qualified as Tier 1 capital also declined from 8,438 to 6,850. Core Tier 1 ratio was same, even though some changes are there in capital, risk weighted assets, everything. The core Tier 1 ratio was 9.62 in both year. Tier 1 ratio has some changes. Tier 1 ratio has 11.69 in 2011 and 12.25 in 2010. BIS ratio also declined from 15.30 to 14.26. Now capital management of ING Bank. ING Group Capital Management is responsible for the sufficient capitalization of ING Group entities at all time in order to manage the risk associated with ING's business activities. This involves the management, planning and allocation of capital within ING Group. ING's corporate treasury is part of capital management. It executes the necessary capital market transaction, term funding and risk management transaction. Capital management monitors and plans capital adequacy on consolidated basis at three levels: ING Group, ING Insurance and ING Bank. Capital management takes into account the metrics and requirements of regulators. ING applies the following main capital definition for ING Bank: core Tier 1 capital, Tier 1 capital and total BIS capital. Tier 1 capital is defined as shareholders' equity including core Tier 1 securities plus hybrid capital less certain prudential filters and deductible items. Tier 1 and BIS capital divided by risk weighted assets equal the Tier 1 and BAS ratio respectively. Core Tier 1 capital is equal to Tier 1 capital excluding hybrid capital. Now we'll look after the uses of capital risk management. It enables financial institutions to quantify the risk they face, the capital needed to cover them, the real risk adjusted return are being made, the ability to enhance strategic and tactical decision making and optimize shareholders' wealth, help organizations to spot threats and weakness, identify opportunities that may be missed by competitors and target investment where it can earn its best return. It can also help to align risk appetite with capital allocation and communicate the tangible strength and potential of business to analysts, investors, and rating agencies. Thank you.